Are you paying more in taxes than you should? Are you using the wrong type of deduction, such as the itemized deductions, when you should be taking the standard deduction? This could cost you thousands of dollars. Itemized deduction versus standard deduction. Which one is right for you? Hey taxpayers, it's Tiffany Gonzalez CPA here with a topic I know that every taxpayer loves: tax deductions. In specific, we're going to be going over the difference between itemized deductions and the standard deduction. Let's start by defining what a tax deduction is. A tax deduction is an expense that reduces your taxable income, meaning you will owe less in tax. It does not provide a dollar for dollar reduction of your tax bill like a tax credit does. Instead, it lowers the amount of income on which your tax is calculated. For example, if your total income is $60,000 and you have $5,000 in tax deductions, your taxable income is reduced to $55,000. Your tax rate is then applied to this lower amount, which reduces the total tax you owe. There's two ways to claim deductions on your tax return: the standard deduction or the itemized deductions. What's the difference? The standard deduction is a fixed amount that taxpayers can deduct from their taxable income without needing to track any expenses or provide any documentation. The amount is adjusted for inflation annually. And this is best for simplicity and most W-2 employees. In addition to the standard deduction being adjusted for inflation every year, if you're 65 and older or blind, those same standard deductions are a bit higher. So who benefits the most from a standard deduction? Well, like I said earlier, W-2 employees who do not have significant deductible expenses, such as owning a home, right? Mortgage payments, property taxes, those without high medical expenses, or those that don't really have large charitable contributions. If you're looking for a simple tax filing process, you're going to go with the standard deduction. For example, let's say Sarah, a W-2 employee who doesn't own a home, has $2,000 in medical expenses, $1,500 in charitable donations. That totals about $3,500. And since it's way less than the $14,600 standard deduction for 2024, rather than attempting to itemize, right, she would instead take the standard deduction. When the total amount of your itemized deductions exceed the standard deductions, it results in lower taxable income and greater tax savings. These are the most common itemized deductions: medical expenses. But medical expenses can only be deducted when they are 7.5% more than your adjusted gross income. And because the 7.5% is a floor, that means that not only do they need to be above the 7.5, they need to be significantly above the 7.5% to make a difference. Another area of itemized deductions is the state and local tax deduction, which is currently capped at $10,000. This is where you can deduct your property taxes or state income tax. Itemized deductions include mortgage interest for qualified home loans. You can deduct the interest that you spend on your home up to $750,000 of qualified debt. What if you have a mortgage loan that is much higher than $750,000? You can still deduct some interest, but some of it will be phased out. And lastly, part of the itemized deductions is charitable contributions, but this also has some limits. There is a maximum that you can contribute to charity based on your income that you can deduct in the current year, and the rest would roll forward. As you can see, homeowners with significant mortgage interest and property taxes are usually the ones that can itemize more than an individual that doesn't have these things. Because again, itemized deductions only comprise of these four key areas. There are a few others, but they make very little difference. So the four key areas again are medical expenses above 7.5% of your adjusted gross income, property taxes, state taxes, income taxes, mortgage interest, again, depending on your mortgage loan, and charitable contributions. A common misconception is that itemized deductions are business deductions against self-employed income. Those are not the same thing. You can always itemize your deductions against your self-employment income. In fact, that goes on a separate schedule called Schedule C, or a business tax return. When we talk specifically about itemized deductions, it's Schedule A. And whether you have a business or don't, you can itemize your deductions if you have these 4 things. We hope you enjoyed this video. Don't forget to hit the like button, subscribe to our YouTube channel, and follow us on LinkedIn, Facebook, and Instagram. Until the next video, your favorite CPA, Tiffany Gonzalez.